Hello and good afternoon. Thank you for joining us today at the Investor Meet and the Q&A. I will now hand over to Manish, who will take us through the flow of the meeting. Over to you.
Okay, so thanks, Mansi. And first of all, I would like to welcome each and every one of you. I know it's hard to take time out on Saturday, and for deciding to be here rather than anywhere else. So we'll try to make this meeting, which is about finance, investing, worthwhile and more so enjoyable. That is more important. So I mean, today's meet will be basically Q&A. I mean, partners and attendees can ask any questions they have on the investment that we have made, businesses, our research process, rates, anything related to finance or any other thing that you would like to ask, and I'll be more than happy to answer that. And last time we met, it was late January this year, and lot has changed since. So there is a war in a Eastern European country. There is a uh, inflation has shot up a lot. It is pinching lot many common people, and more so the investors and finance community are more fretting about central banks who are now in a territory of tightening the rate cycle. So even for the central banks who ignored this the effects of money printing for the last 2 years, they have woken up to the reality of unsustainable and pretty high, almost 30, 40 years high inflation almost everywhere in the world, including the developed world, which has not seen in last 30 years. So, so we'll be covering all that through your questions. And uh, whenever I write any letter to a partner, or whenever I'm preparing for any meeting, the one objective that I carry is how can I deliver value to the partner? How can they how can they read my letters? How can they watch what I say? How can I write about the complex subjects that will make them uh, understand financial things better and make a good decision. So when I was coming to the meet few weeks back, one of our partner called me and they said one of his friends want to talk to me and he want to explore the opportunity to join our partnership. I said fair and good, talking is fine, and we went on to the phone and just in few seconds into the call, the guy started talking about more about why he should not go to a investment bank or big hedge funds which are there on the financial papers, media, and this and that. And he went on and on and on and on. And I was while listening to him, I said to myself that oh boy, this dude is so ignorant. And he doesn't know how this big financial institutes work. And the problem is not only he, I mean, any even for the educated people, very few people understand how this financial institute works. And that includes my own friends, that includes friends of my relatives, friends of friends, friends of known, and many more people. So, but I felt when we do this meeting, I will try to convey that message in a very funny, subtle, and yet to the point way. And so me and Mansi, and while preparing for the meet, we decided to play a small two-minute video, which has been taken from one of the movies, and we'll play that video, watch that video, enjoy that video, but take that important message that we are trying to convey. And Mansi, if you have that video hand, you can have that on the screen. And after that, we'll open up for the Q&A. Feel free to ask questions. And all the partners and friends who could not attend, they have mailed in their questions. We'll take that also. Mansi, video on the screen, please.
Incredibly excited to be a part of your firm. I mean, the clients you have are absolutely
Fuck the clients. Your only responsibility is to put meat on the table. You got a girlfriend?
I'm married. I have a wife. Her name's Teresa. She cuts hair.
Congratulations.
Thank you.
Think about Teresa. Name of the game, move the money from your client's pocket into your pocket.
Right, but if you can make a client's money at the same time, it's advantageous to everyone, correct?
No. Number one rule of Wall Street. Nobody I don't care if you're Warren Buffett or if you're Jimmy Buffett. Nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi. It's a woozy. It's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right. Stay with me. We don't create shit. We don't build anything.
No.
So if you got a client who bought stock at 8 and it now sits at 16 and he's all fucking happy, he wants to cash in, liquidate, take his fucking money and run home, you don't let him do that.
Okay.
Because that would make it real.
Right.
No, what do? You get another brilliant idea, a special idea, another situation, another stock to reinvest his earnings and then some. And he will every single time because they're fucking addicted. And then you just keep doing this again and again and again. Meanwhile, he thinks he's getting shit rich, which he is on paper. But you and me, the brokers, we're taking home cold hard cash via commission, motherfucker.
Right. That's incredible, sir. Can't tell you how excited I am.
You should be.
So that was a fun video. I hope you all enjoyed it and got the message as well. We are now open to questions, and I will take the questions alternatingly between questions from the live audience as well as mail-in questions from partners who are not here today. You are welcome to raise your hand over Zoom, and I will go one by one. I suggest that when you ask your question, please keep your video on. Our first question is a mail-in question by Aswati. Aswati is a partner from Ontario, Canada, and she says, sorry for missing the meet, but I'm working on a weekend since work from home is over. First, I would like to thank you for exiting a handful of positions and being in high cash position. The present market meltdown seems very excruciating. How did you see the fall coming last year? Do you think 2022 is a year of capital protection? If Constellation Software falls below our exit price, are we going to get back in? One small question for a friend. She has her savings invested in ARK ETFs and it is down like 75%. Can we guide her? And she wants to know if she should average down. Thank you.
Thanks, Aswati, for the question. I will take the part of the capital protection part first. So the one question every investor grapple with is when is the time to protect the capital? I mean, that's the question on everybody's mind. And let's say what generally happens in market is when the stocks are imploding, when things are falling apart, when people are losing money in the stocks where they have gambled in past 2, 3, 4 years, they feel that is the time to protect the capital. But ask yourself a very simple question. Suppose you are if you're driving a very high-speed car on a highway where the speed limit is 100 miles an hour. That's 160 kilometers an hour. And you decide to put the brake when your bumper is kissing the rear seat of the front vehicle. I mean, if you think that, I mean, that is too late. I mean, you should have put brake, I mean, long before. So same in the market. What you do today depends more on what you have done last year, last to last year, and last to last year, right? So if somebody's capital is invested in stocks where there was only stories on the media, or the fund managers have ratchet up the prices, I mean, no year is a good year for capital protection because they are going to go bust. That is the reality. That is the sad reality. And coming to us, I feel 2022 will be a year of capital deployment. Why so? Because we are seeing a lot of meltdown in market globally, not so much in India, but it has started. And when that happens, when people are fearful, the handful of businesses that we love, we have already done our research on, and that comes to our reasonable price range. We are going to invest in it. Okay, so 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 I see 2022 is a year of capital protection, and and coming to the part of how did I anticipate the fall? First thing, nobody can anticipate anything, and people who tell you what is going to happen, you should run away from that. Be it astrologer or anybody who thinks they're expert. My job is not to predict when the market will fall. And I keep getting this question. My job is to do right thing, right? So last year when our investments value were, once again switch off your mic, please. Getting off. So last year our when our businesses were egregiously priced, I decided it is fair enough to exit those positions, because the amount of productivity that is there in the future is not there in the price anymore. So that's the thing, and we did right thing, and that's why we are in right situation. For the new partners, we have not deployed big capital in last 2 years, and they are high on cash. So our present position is good for us because we want to invest. Prices are coming down, and it is more so because we have done so in the past, right? So that's the way I see it. And if Constellation Software falls below our exit price, I think any business investment is done on a simpler criteria, that how much return it can generate for my family and my partners, right? So I don't buy a business because it is a Constellation Software, which is an incredible business out of Canada, and I think Mark Leonard is one of the best operator managers you can ask for. But when we sold Constellation Software, it was trading more than 120 times uh, earnings, and to just give an perspective, if a company doesn't grow, it takes 120 years to get back your money. That's what 120 times earnings mean. So to justify those holdings, we need to justify the company will grow so much and so much. But I felt the company grow any amount in vertical market softwares. We are getting too much price because of speculations. We make good profits, and buying it back again in future. Any business comes to a price where we feel the productivity is more, price is less, we'll do it. So I will not comment anything at the moment. At the moment, it is highly priced. I'm not looking at it.
Okay, sure. I will now take a question from the live audience, and
Yeah, sure.
we have Danindra here who will be asking his next question. Please unmute.
Yeah, sure.
So my question will be revolving around my discussion and the previous information that Manish informed me that we will be investing in Amazon and Google. So I just want to know why business of Amazon and Google look like this, and what are the business values that you look into the compared to other businesses which will make it an attractive business, and how you navigate for the business that will be investing in the future.
So yeah, see, Amazon and Google are both incredible business. There's no doubt about it. The question is, are they incredible investments? So that's the important question we need to understand. And any opinion formed about any investment about the business, not based on your understanding about the business, its future about its future productivity, is a speculation, I think. So let's see at Amazon. So Amazon at the moment, we can broadly split its business into e-commerce retail, where it does first party sales, third party sales, Amazon ads that you see on the Amazon website. It has Amazon Prime subscription, and it has fulfillment for the third party partners, and so on, right? So that's basically the e-commerce system and ecosystem, and whatever revenue they generate through that ecosystem, through ads or through subscriptions. And there is a second business of Amazon, which is Amazon Web Services, right? The cloud business, in which Amazon is a market leader at the moment, right? They have more than 33% market share worldwide, and I expect them to grow. Now I'll tell you how do I think about it. Suppose I need to justify Amazon as a business for investment. First thing, I forget that Amazon is listed in. I don't need to see what is the stock price, Because when you look at the stock price, you see, array, it has fallen 30%, it has fallen 20%. Those judgments are just your opinions. Like, we feel a lot of things, but those feelings have no feelings. So let's assume that Amazon is not trading anywhere in the world, and we need to come to a valuation irrespective of what is the stock price. Suppose you go and buy a bakery in your society, there's no stock price. You ask, what is the cost of the land, what is the cost of running the bakery, what is the cost of paying people, what is the cost of sales, and then what is your margins, and then what is your capital turn, then what is your how do you sustain during the COVID, how does the trend look like from last 5 years, and so on, like the inputs that you need to know to justify or to understand the economics of the business. So broadly, if I have to say, Amazon at the moment does around $460 billion of revenues, right? And 15% is AWS. So e-commerce ecosystem is 85%. Now, a very simple thing is, the only profitable business of Amazon at the moment is AWS. So AWS does about $70 billion of revenue, and it is expected to grow 35%, 40%, which I feel will slow down in the future, but that's a very healthy growth rate. And AWS is incredibly profitable business. I mean, it makes 30% plus margin. How many businesses in the world make 30% plus margin? You can count on your finger. But the thing is, we are buying Amazon as a whole. So the ecosystem, which is 85% of those 460 billion of sales, uh, they are loss making. They are not making profitable. They were profitable in 2020. So the profit range is generally 3% on the total sales of that 85% on 460 billion. And in them, there are some loss making, some profitable, like subscriptions are profitable, but then you say, can they have subscriptions if they don't have first party and second party and fulfillment and ecosystem and all that, right? So let's take Amazon as a whole. So now we need to ask that, we have a business, can everybody just uh, uh, mute your themselves, so that so so now we need to ask ourselves a very simple question, that there's a business, AWS cloud business, 70 billion sales, 30% margins, and there's another business which is $390 billion sales, that is 85% of 470, and they are making about no profit. So they were plus 3% in 2020. They are right now, I think latest quarter it is minus 3%. My numbers may be slightly off the chart, but my numbers are generally, I remember them perfectly fine. So now we need to ask ourselves that, in case Amazon try to make profit, right? But the other thing is, now look at the expenses. Why Amazon doesn't make profit? We need to understand. If you cannot understand this question, we are not going to answer, is Amazon is a good business? Now, Amazon employs a lot of people. They hire a lot of great talents from the Ivy League colleges, IITs, IIMs, and they are paid partly in stock. I mean, 50% of their salary or 40% of their salary is stock. So imagine you are passing from IIT or IIM and you got a 70, 80 lakh package from Amazon, and they said, dude, you are going to get 40 lakhs in stock, and our stock is the great stock because everybody says so, CNBC says so, Pop says so, this says so, and hedge fund says so. But that makes no sense, because you need to have your own understanding whether that stock is valuable for you or not. So Amazon stock option annual expense is about 1%. Okay. So Amazon not far ago was trading at 1.7 trillion. So they spend 1% of that 1.7 trillion as a stock option to their employees. So if they don't give stock option, they have to give salary, because if I tell Dhanand I'm going to hire you for 80 lakhs, and he feels that 40 lakhs of stock option is not that much valuable, I need to pay him in the cash, right? So Amazon, that's so five so 1% of that 1.7 trillion is 17 billion. So we have to assume, what if in future Amazon stock price doesn't go up, and the employee says, listen man, you gave me stock option at $3,700 per share, now it is half. I mean, from being a 80 lakh package, it has become 60 lakh package. I feel very poor. Amazon has to pay in the cash, right? Or Amazon has to give double the stock option. So they dilute 2% per year. Then you have to assume both probability because we don't know what Amazon management will do. But we know for sure that people who want a good salary, they are not going to sit quiet, right? So that goes into your model, and then you ask a business that earns 3% margin with that much scale, that much fulfillment, that much market share is not able to maintain margins because of inflation. And if they have to put on additional $17 billion of expense on their balance sheet, what does the future look like? And when you figure out all those things, Amazon may raise their subscription by 5-10%, but you say our subscription is just 8%, so increasing 5% make not much of sense. It just adds 0.4% in the net revenue. So it is not moving the needle, right? So you may come to a valuation like Amazon made. I'm ready to buy that business at say 600 or 800 or 900 billion dollars. That range, 600 to 900 billion dollars, and then you go and look at stock. Oh, what does the stock market says? Stock market says Amazon is available for 1.1 trillion. Then I say, oh, it's too expensive for me because I've done a very good research in understanding business. So when you do this kind of analysis, when you try to find answers, you may not be able to find all the answers. But when you do this kind of analysis, you are going to beat most of the market participant, Wall Street analyst or Dalal Street analyst and fund managers because they're doing nothing. They're just using Excel. They're not thinking. And that's what I think about Amazon, right? I'm not going to tell you what is my personal valuation about Amazon. When we buy it, you'll know. So I'll keep it to that. But it was to give you an idea about Amazon business. If I have to analyze, how do you analyze that? Same thing with the Google. Google is one of the best business. YouTube is one of the best platforms. Search engine is almost monopoly, and they make big margin. Unlike Amazon, they make 250 billion of sales and they make 60-70 billion of free cash flow. Right. So we need to ask, how does Google make money? Google make money through ad. What happens to ad during the recession? During the recession, ads go down, and how much it can go down? What is the past trends? What does local people say? And you need to ask all those tough questions. There is no easy answer for them, and you go into a rabbit hole and find those answers, come to a valuation, and then when the market uh, throws your price which is far below your, because market is not doing all these things. Market is thinking Amazon is value 1.7 trillion. When it was 1.7 trillion, everybody is saying it is value 4 trillion. When it is falling, everybody is saying it is 500 billion because they're just talking from the sense of emotions, right? You have to think like a business owner. If you are running a business, if you own a business, and come to a valuation, and when the price is present to you where you see, okay, we get great productivity, a very good 18, 17, 19, 20 or whatever percent of return per year, you make those investments. So that's how I talk about Amazon and Google. And Danand, I hope I answered it. Don't ask me what is that figure. That figure will be known. I mean, it is an exercise for you. If you want to analyze any business, do it this way, right? Take it as an thought process. Did I answer your question, Danand?
Yeah.
Yeah. Okay, thank you. Can we have the next question, please?
Yes, sure. The next question is a mail-in question from Michael Lamb, who is who's an investor and a friend from Austin, Texas. He says, Manish, what is your take on current inflation and rate hike cycle? Do you believe that it will lead to serious asset prices destruction? Markets have been pretty crazy, and such serious declines in last few months remind me of the dot-com bubble, where many stocks lost 95%. Your theory of money flow was very interesting, though I never understood much, but eventually you got it right that Fed will hike rates when they would hate it the most. How much of tightening is in store? Best of luck for your fund.
Uh, uh, am I audible? Yeah. Okay. So uh, the first thing is all the questions is basically macro questions, and I'm not going to answer that whether the market will fall 95%. If I knew, I would have made money out of it. But I don't know. I'm not an astrologer. I don't want to even believe that I can do that. So it's a macro question. I don't know how many participants likes macro, but let me try. So most of the people who are working, they think that they understand money. They know what is money. Money may be the what they have in the bank, or money may be what is their salary, and money may be what is the interest rate they are getting. But but the reality is most of the people don't understand money. So let me tell you, forget. Let me tell you a simple story that will give you an idea what I'm going to. I'm trying to break down a complex topic which doesn't bore more. Hopefully, doesn't bore you guys. And so imagine there is a builder in the town, and for this for the sake of the story, imagine you don't know what is money. Money could be gold, money could be house, money could be stocks, money could be your graduation degree, because anything that can generate some productivity for you could be a money. So let's assume we don't know what is money. So there's a builder in the town, in my hometown, and he finds a piece of land, 10-acre land, and he says that, okay, I'm going to make a residential society on this land. He comes to the owner, and the owner is me. So I tell him, I am going to charge you 100 crore for this land. And builder said, wow, 100 crore doesn't sound that much. So I don't have that much money. So builder goes to bank. Builder says, I have seen a very good land. It's a fantastic land, lot of productivity. I'm going to make the most beautiful residential housing society, and you must fund me. And if you're not going to fund me, I'm going to go to 10 banks. Bank says, no, 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 no. You don't need to go anywhere. I mean, how could you think that we will not fund you? I mean, of course we'll fund you. You are a guest. Have a coffee, have a cake. And bank says, how much money do you want? Builder says, I have 20 crore. I just need 80 crore. That's it, not much. Bank says, only 80 crore. That's it. Oh, okay, take it. And builder goes and buys the land. So now two people are involved. One is a builder, one is a bank. Builder has 20 crore money on that land, and bank has 80 crore. Now builder decides to build the society. And builder plans that once the society is done, every house is done, I'm going to sell it everything for 200 crore. So let's assume there are 200 houses in the society, and every house is priced 1 crore for the simplicity. Now those people are very happy because they are buying a very good house in a residential society. They are jumping because they've got a great opportunity. Why? Because builders say so. It's the best society in the world. Bank says so. Bank says, if you want loan, come to us. We are going to give loan. No questions asked. 3 paper, Aadhaar, PAN card, and you are done. Right? So the 200 people says, what is the rule? You pay 20% down payment and 80% bank and finance, right? So those 200 people pay 20%. 20% of 200 crore is how much? 40 crore. Bank says 160 crore given. A bank gives 160 crore to those people for their houses. Now let's pause there. I can keep going on, but let's not confuse with the numbers. So how much is the housing society is well? 200 crore, right? Every flat is 1 crore. Now how much money the residents are paying? 20% of 200 crore, that is 40 crore. How much bank is paying? 80% of 200 crore, that is 160 crore. How much bank has already paid to the builder? 80 crore. That's make 240 crore from the bank. 240 crore from the bank, 80 crores, 40 crores from the individuals, and 20 crore from the builder. Right? Initially, he put 20 crore. That's 300 crore money involved in a property that is worth how much? 200. So that's how you create money. Money is created through the flow, right? And if you think that's now is if you think that it is done this much, no, there is an insurance guy. Insurance is a subsidy of the bank because you want to insure your house. So the insurance banker says, go, this is a good residential society, go and ask people to insure their house. We'll just charge 2% of the value as a premium. 2% of value is 4 crore. And bank is ready to underwrite safety of 200 crore project. And that big liabilities. I can keep going on. There's a guy who has taken the contract to do the tiling and all the interiors, and he says my cost is 40%, 20, 25, 30% of the whole project. 25, 30% of the whole project is 50, 60 crore. He can go to the same bank and take loan. You can keep doing it. You can keep flowing the money and keep increasing the value, but you need to ask. See, everybody does it. It happens in residential society. Now look at Indian government. So Indian government, how much money do you think Indian government make? So I will tell you very simply, India's GDP is about 210 lakh crore. How do I know? Government says so. So and Indian government make about 22, 21, 22 lakh. But just for the simplicity, let's assume that they make 22 lakhs. It's simple to calculate and multiply. So how does they make this much money? They make 5 lakh through the personal taxes. They make 5 lakhs through the corporate taxes. They get GST input, and they get dividend from RBI. They get dividend from PSU. They sell some PSUs, and their budget estimate is 21 lakh crore. Now you ask, wow, that's good money, 10% of the GDP. Yeah, GDP is 210 lakh crore. Government is making 21 lakh crore. But let's see at what is the expenses of government. So Indian government expenses, just the salaries, subsidies, uh, pensions, and all those things, the fixed cost, where they cannot reduce even 1 rupee, is 32 lakh crore. So just the salaries, pensions, because Indian government cannot cannot tell a government employee, you know what, you are a good guy. I really like you, but I cannot pay you. Thank you for working with us, and we want to have you for 30 years. They have to pay, right? So 32 lakh crore is Indian government expense. Earning is 22 lakh crore. And this expense is not productive because they're not building bridges, they're not buying the trains. So government need to do over it. That is called capital expenditure above the fixed cost. That that varies from the part to part. Now you ask yourself, where does the government get this money, extra money, 15 lakh crore, 17 lakh crore? Of course, government take debt, but government has taken debt in the past. Government don't want to add on the debt because then the foreign credit rating agency will say that, oh, you are taking debt. I'm going to degrade your rating. You need to pay. You need to increase your coupon rates. So government says, put money in GPF, and what we'll do, we'll buy gehu from you. Okay. Government has to pay you 8% tax or interest on your GPF, PPF, and government is buying grain, or maybe giving pension, or maybe giving salaries from that. And you maybe your salary is from your own GPF, and then you put again in the GPF. It is just going round and round and round. All these things works until it doesn't work. So what is the catch in this? Any flow of money is fine if the future productivity matches up, right? So you can buy that residential property for 300 crore. Imagine that future value is 400 crore. So bank is still safe. It is 33%, 25% below that future value. Everybody assume, because you have to assume that so much of productivity will come, and then my stupidity will be taken care of. But the problem is, you are not the stupid guy in that town. There are so many. You're buying for 300 crores, somebody is doing 800 crores. And that's what happening. That was happening in the first decade of 2000 in India in real estate. So if you study the flow of money, how the money flow creates value, you can answer two very simple questions. It is not taught in economics because most of the economics have not studied it. Even you go to Ivy League college, best college, Harvard, they don't teach you money flow theory because it is not acceptable. Government doesn't accept it, right? I'll because if I'm not boring you, I'll just keep on for 2 more minutes. So bear with me. I mean, I'll try to make it interesting. It's very complex. So what happens? You have to ask two questions: is the productivity just because of the prices going up and flow of money, or the productivity is due to the real productivity? If the answer is real productivity, all this all this all these financial jargons will help you out. I mean, uh, you are paying something up and the productivity goes up and you are fine. Everybody expects it, right? You cannot assume that tomorrow will be a bad day, right? Everybody assumes that future is going to be bright, India is going to grow, and all this. I'll give you an example of Japan, which I've written extensively in last year annual letter, but I see new participants in the meet, so old partners will find it boring, but let me just repeat it. So Japan in 1989 was valued $5 trillion GDP, right? So India is 2.6, $2.8 trillion GDP right now. Japan in 1989 was 5 trillion. And if you read any economics paper in the future of that time, sorry, you go to Google, you go to encyclopedia, you go to some archives, everybody thought that Japan will become $15 trillion. Now, it will surpass US in say 10 years. And 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 you will be surprised that there was no one who said that Japan will not grow, because it all the manufacturing boom came through Japan, all the electronics equipment came through Japan, and all the economists. I mean, if you said you will not, Japan will not grow, you will not get job anywhere, even as a clerk. It was so bad, right? So Japan economy in the 1989 was 5 trillion, and I remember very because that number is ingrained in my head, because I have spoken so much about it. Uh, the Japan stock market was peak, that is Nikkei. Nikkei peaked at 38,916 on December the 26th, 1989. And how many years have passed? We are in 2022, 33 years have passed. We are minus 30%, minus 25, 30%. 33 years, forget about zero return, which is minus return. Now we can say stock market doesn't matter. Let's talk about real economy. So as I said, real economy in 1989 was 5 trillion. What is the economy of Japan right now? 33 years have passed. It is not even 5 trillion. It is slightly below 5 trillion. It touches there, but I think yen has depreciated. So it is say, let's assume it is 5 trillion. So 33 years, no growth, not even a single dollar of value or productivity has been added. It can happen, but the thing is not finished. Let's say now what the Japanese central banks have done. Japanese central banks have said, we will keep the rates zero, we'll print money, we'll give free money to the people, and will inflate the economy, because when free money will come, people will expand. As I told you, the flow of money creates new money, right? More the money flows, more value is created, which is a value out of thin air. So Japan central bank from 1989 till date has printed about, I think, 130% of the GDP. That is $6.5 trillion of currency printed, not because of productivity, not because more people are working, not because companies are growing. Printed, right? They said that we are going to print, and somewhere in the future, productivity will come. $5 trillion GDP, 6.5 trillion free money, yet not even one single dollar of value is created. Now you say some, when I talk to this to my friends, investor friends who are professor of economics somewhere, they say Japan is a exception. Right? Now let's talk about USA. So in 2000, during the dot-com bubble, USA GDP was 10 trillion, right? And the total debt on the USA balance sheet was, I'm talking about government and private credit debt, it was 25 trillion. So in 2000, US's tech bubble, where a lot of people become bankrupt. In 2008, when the housing bubble was going on, US GDP was 14 trillion. In 2000, 10 trillion. In 2008, 14 trillion. Wow, 40% growth. But how much the debt was added? So debt was added 25 trillion. Just to create $4 trillion of value, $25 trillion of debt was added. So in 2000, the debt was 25 trillion. In 2008, the debt was 50 trillion. I can keep going on. If I tell you the present number, you will stop. So whenever any value, if you think it is happening only in the countries and central bank and national level, it is happening anywhere. I mean, when you see a stock, when you see a fund manager come to CNBC and say blah blah stock is going so much percent, it is going to change the world. That means what they actually mean is, please buy the stock, let me make money through brokerage, and hell with you. That's what they're saying. So this goes on. So as an investor or as an individual, our job is to just distinguish two things: avoid things which are just going up because of the prices, leverage, or flow of money, and buy things which are growing in the productivity. So if you bought Apple, Apple has sold many phones, increased their sales and revenues year after year after year. So that's a productive asset because it is actually growing. So the price growth is genuine. So as an investor, my job is to just buy productive assets for myself and my partner. And whenever I see there is a bubble because of the flow, because of the mad speculation, gambling, my job is to avoid it.
AK is our partner from Singapore, and he says, hello Manish, where do you see the next opportunity set to invest in? Shall we invest more aggressively as many stocks have fallen? Does the current supply chain and wage inflation affect our naked wine investment thesis? Also, I recently checked your website. Would love to hear your investment story of Aisha. 21x is quite some returns. I'm sure you will find one such in next 10 years.
I lost the last part. What was that? I would like to hear the story of.
Yes, I recently checked your website. Would love to hear
Okay,
your investment story of Aisha because 21x is quite some returns.
okay, okay, okay. And this is from UK, right?
Yes.
So, as far as opportunity set is concerned, I mean, our simple thumb rule is invest where there are opportunities. So we don't decide that we want to find opportunities in India. If you find a good opportunity in any business in UK, we'll invest there. If you find a good opportunity in American business, we'll invest there. If you find a good opportunity in Indian business, we'll invest there. So that's how it is. And about investing aggressively, I mean, we are not gamblers here. Gamblers do aggressive, and I believe that investment should be decisive. When your work is good, when you know that you understand the business, when you've done the tough work. So if the question is, are we going to invest decisively? Yes, if our businesses which we want to own in our portfolio and partners portfolio comes to the level, we'll of course make decisive decisions. And I think he had a question on naked one, right? Can you repeat that question, please? I just lost it. Your mic is off, Mansi.
Yes, please excuse me for that.
Yeah.
He says
What is the
that does the current supply chain and wage inflation affect our naked wine investment thesis?
So yeah, that's a good question because that's on my mind as well. Let me tell you that naked wine is one of the, I mean, it is the largest direct to consumer wine retailer, right? And whenever somebody who is in a business where they have to supply directly to consumer, uh, they have more, the main cost apart from the cost of the goods is the fulfillment cost and the labor cost. So any inflation affects them, right? But apart from being the best or the largest winemaker in the world, Naked has a very unique model where they take out all the middlemen, they take out the distributor and retailer, so they can sell a bottle for far lesser price with profitability, right? So any wine which is suppose a wine is coming from Napa, California in United States, and if the retailer is selling that wine for $40 a bottle, Naked can sell it profitably at $25 a bottle. So when inflation goes up, I mean, distributors has to pass on the price because they will not take losses. And because of the three-tier system in USA, everybody has to make margin. Distributor has to make margin. Retailer has to make margin. And so the consumer gets very inflated prices on their wine bottles. So so that buffer between naked price of profitability and the distributor price, and sorry, the retailer price, and them being more affected in inflation, I think that will be the advantage for naked. I was listening to Nick Devlin's interview recently where he was talking in great detail about naked wine. To be very honest, I'm more confident in naked after this. I feel naked is going to be a good investment for us, and we are not done investing yet, right? So I hope that answers your question. And there was a question on Aisha, right? Uh, the first thing is Aisha, in last 14 years of investing, Aisha has been the best investment so far. I mean, we made 2000, I think 2100% returns somewhere. Little more, but let's say 2001% return on Aisha. And it was good for us more so from the point of view that I felt that I understood Aisha's business far more than anybody in that moment of the time because on those days I was traveling from trains to Kerala to go and talk to dealers. I was visiting the factories, and Siddharth Lal, who took over from his father. Aisha before was a legacy family business. They were into 13, 14 verticals. They were selling juta, they were selling kapada, sab kuch, engines, motorcycles, and they were not doing anything good. So Siddharth Lal came to the uh, when he became CEO in early 2000 or late 1999. He decided that I'm going to take out all the business. Because we don't have to be in all the business. We are going to focus on bikes. And he did a lot of changes. I mean, those initial Royal Enfield bikes were like rusted, welded, not so good looking, cranking, leaking. I mean, just it was very hard to maintain those bikes. So though there was a loving people who loved owning a Royal Enfield, it was very hard bike. And he was doing a lot of changes. For example, I will tell you one change. In initial years of 2000, when I was studying naked, I was studying I studied in 2008 9, right? So when I was reading about what they did in 2000, so the bikes had a lot of cost because when the bikes was when our bike was uh, transported to the dealers in Kerala or anywhere else in India, there used to be a lot of breakage. So their maintenance cost, their repair cost was so much. So he took that thing and he did a lot of changes. He did a lot of changes on packing, type of trucks that will ship those bikes, and that did added to the cost. But in the long run, it became more beneficial because the bikes were transported almost scratch free, and he also changed the architecture of bike line assembly. I don't want to go in a lot of detail because that's not the point. So when I bought in 2009, Aisha was quoting, if I'm not wrong, somewhere around 500, give or take 10-12% here and there, if my memory is right. And they were selling about 50,000 bikes. So I made it was very clear because when I was going to the Kerala, they said that we have a order of we have a ask of 2,000 bikes and we have just 1,000 supply. So most of the dealers had more demand than the supply, and we were talking to the company, going to their factories, and they said that they are going to ramp up the demand. So that was the initial hand, idea to invest in ICER, that it is going to double its production from 2009 levels, which was 50,000 bikes per year, and they were doing it much more profitably. Company were the sell side analyst or other brokerages, they didn't have this insight, so we invested almost heavily, very heavily. I mean, 50-60% of our portfolio into one company because we did a lot of hard work. I shared from 2009-10 till 2014 when we exited iShare, it increased its bike sale from 50,000 bikes to 3 lakh bikes. Imagine that it has never happened anywhere in the world. And the bike iShare was selling in early 2000, and the bike they were selling in 2010s were totally different. I mean, people were not buying Royal Enfield because they loved Royal Enfield. People were buying, they were not buying a bike, they were buying their lifestyle. So Siddharth Lal did a good marketing in making people believe that you can travel on this bike, you can do adventure on this bike, you can live on this bike. And the craze and the customer stickiness was such. I mean, any business owner will tell you that the best thing they want is stickiness of the customer, where the customer are dying for their product. I mean, if you buy a Apple phone, I mean, it is just out of the store in no minute if you are not pre-ordering it. So that was the great case. We made a great investment, and I think, to be very honest, Aisha case studies should be taught in the business school. I think it is not only one of the best business out of India, it is one of the best business on the planet.
Yeah. So coming to the Indian economy, when we see there is so much sell-off, and initially in the meeting you mentioned there is things
Danan,
which are going down.
Danan, you are not audible to me.
Hello, am I audible
Yeah,
now?
yeah, please shoot. Let me try a minute.
So initially you said there is a good sell-off, and because of Indian government there are different money flows. So I would like to know, is there a Indian bubble market in the stock market? So how Indian economy look like in future, and what are the investment, and when will the investment opportunities will be coming in Indian market? How things will look like for in future?
Uh, as far as I am concerned, there is a lot of speculation in Indian market. A lot of fraud companies are putting their books. A lot of fund managers are doing more gambling than investing. And those are the situations where one need to be careful. And you need to you need to think this way. When somebody puts money in the bank and bank says that we are going to give you zero, that's what happens in USA. I mean, at least 6 months back, people don't want to keep money in the bank. Even the bank doesn't want you to keep money in bank because they have to employ bankers where they give them salary if they cannot lend it. They will give it to fund managers, they will give it to margin, they will give it to somebody like Bill Wang that I wrote about in my book. So there's if your business model is money is going to be cheap and at 1%, I mean, good luck. Money will somewhere in the future be costly, and you will not be able to earn it, right? So it's Indian startup market is in total crazy euphoria state. I think 95% of them will go bust. You can write it down. I mean, we'll talk after 2 years because they make no money. Money is going to cost the VCs who have taken the money from the banks and bankers to give that money. I was reading Sequoia and Tiger Global. They are asking the entrepreneurs to make profit. I mean, it should not be asked. Business job of the business is to make profit, right? It should not be a dream and fantasy that one day we'll make profit. I mean, if making profit is your fantasy, I mean, good luck. I mean, so Indian market, there is a lot of euphoria. Indian retail participation is all time high. I think pre-COVID we had three crore accounts. Right now we may be having north of 9 crore accounts. Indian employment is total 40 crore. Out of those 40 crore, how much is labor, how much is this and that, and how much is knowledgeable people. So you can imagine the retail participation. It is maximum. And whenever in the history, wherever in the world retail participation has been maximum. Retail has no knowledge of investment. They gamble. They gamble to make quick money. Right? It always goes bad. Right? So that cheap money from America that came because of the money printing, the Fed printed $5 trillion, almost 1.5 $2 trillion came into the equity market worldwide. It will stop sometime. It has stopped, right? And then how does the business convince that we are making loss? And, and that's a disaster. Whenever somebody is high in cocaine, you cannot say that the future is bright. And that's what happening in the market. As simple as that. Yeah. So for the opportunities, I mean, we are business specific people. We are not astrologers who are predicting things. Our job to study is to avoid things which is crazy. Our job to study is to find things which are productive and find the imbalance. Right? So whenever that opportunity comes, you will know. Yeah. Thanks. Do you have any more questions?
Yes, we have. The next question is a mail-in question by Catherine.
Mail-in question
From Catherine, who is
Okay.
CIO of a hedge fund and also a friend.
Yeah, Mansi. Yeah. Carry on. Tell me.
Yes. She says, Manish, you told me that a seamless web of human trust is what creates best value for everyone. However, us as investors know how difficult it is when people are ready to cheat and most are so moody about their money. It is far easier to get a client lying than telling the truth. I'm also curious, how do you find clients without any legal team? Any hedge fund has big cost for legal. Do touch upon this. Let me know your next trip to States. We are long due.
For their capital, for their future, for the emotions, and whatnot. I mean, what a bad way to live a life to just run behind money. I mean, of course we want to make money, but we want to make money which benefit us and which benefits everybody. So I truly believe in seamless web of trust. A few days back, I was talking to one of there's a friend of mine who is a teacher in Bihar, Begusarai, a small place, and he's not very well off in financially because he teaches privately and he earns like very small money. And you ask me how does he become my friend? I met him once in a train journey and he becomes friend. And it's been 15 years since. So, and I was telling him this that imagine somebody from Begusarai, which is a small place in Bihar in India, Somebody's father is a daily laborer, right? He earns about like 400, 500 rupees for 10, 15 days a month, not for the all days of the month. And his son is bright. He's very bright. He's very studious. He's smart. He can think. Imagine the whole ecosystem of Bihar will not ensure that he goes to a good school. What a waste of talent, right? What a waste. What is the ecosystem if it does not let knowledgeable people come on the top? But there comes a seamless web of trust. Now, what is the seamless web of trust? Is the different ecosystem which are coinciding with each other, and they are their only uh, their only basis of existence is deep trust in each, without knowing them even. So let's imagine that son goes to Jawahar Navodaya Vidyalaya, which was started by some politician because they felt that the poor kids of SC/ST and tribal areas and very poor Indians can study there for free. Now, the poor guy's son from Begusarai can find a school which can give him education. Right? He goes to JNV, and that's the simplest way of trust. But he doesn't go to JNV. He studies and he cracks IIT. Imagine IIT, a setup where the best technologies colleges of India will take in students from backward people, and they because there is some quota, and somebody who made quota maybe made from political reasons. But for this kid, that is a blessing. He goes to IIT. Wow, a seamless web of trust of JNV and IIT and the quota gets this kid from the very poor backwards place of Begusarai in Bihar to IIT. And he studies computer science and he goes to work for Google. Now, Google is a company out of California in US. It's one of the biggest company in the world, best company everybody wants to be. Google doesn't care whether he comes from Begusarai or he's what caste, what ecosystem. They are only interested does he has the skill. He has the skill. So this unknown seamless web of trust gets a boy from a very backward place from Bihar, Begusarai to California, USA. And the boy doesn't know about that. If this trust web of trust exists, right? And those seamless web of trust creates such a great value for one life where the entire family is taken out of poverty. They live life which is one of the best life on the planet. And you can Google and find out how many of JNB kids whose father were earning 3,000-4,000 a day. Maybe they are laborers, they're sorting garbages, which is very sad, not funny, but they end up with the top institution. And they didn't end up because they belong to Bihar. I mean, I see Bihari takes a lot of pride in Bihar. Who brought them to the California? The seamless way of trust, right? And we should always try to create those webs. I think uh, that's why we are meeting. I mean, why I'm taking questions from somebody who I don't know apart from because I feel maybe I can add some value and he or she can go somewhere and talk about me, and that creates a seamless way of trust. So when life is based on seamless way of trust, few things happen. You live your life in a very good way. Your life is not of resentment. Your life is not of irritation. You try to create value for others, and by creating value for others, you are creating value for self and for the ecosystem.
Hello,
Yes.
Mansi, Ronit here.
Yes. Hi,
Second,
Ronnie.
come on video. Hello, am I audible?
Yes, you
Yeah,
are.
yeah, you are audible. Please ask.
Uh, Manish, so I have a question related to the investments that you are doing. Okay, like you said, it's about productivity and the businesses that you invest in. So there's a
Yeah,
lot of objectivity involved there. Like you're talking about the numbers related to the companies, but at the same
yeah,
time you're saying everything we cannot get right when we do try to get the numbers, or
yeah.
everything we cannot get, but there will be some set of, is there any subjective decision making involved here, like let's say in terms of the outlook of the company or the trust that you put into the management, and also industry they are in, I mean, so that kind of thing, like when you're deciding on the stocks that you invest
That's a very good question. That's a very good question. Thanks for asking.
in. Yeah.
See, if any investor says that whatever I have done, whatever I've studied, there are a lot of things that can be studied objectively, like the numbers, the record, what they have done, the competition, what are the margins of the competitors, why somebody is better, have better margin. Sometimes the the pull and push of the product, whether the product is a pull product or push product. Those things we can very answer it very tangibly, but there is always a subjective element to the investment. I mean, how does you judge the manager who is running? Suppose I need to judge Nick W, who's a CEO of Naked One, the company. I need to tell everybody that I used to in this company. How does I judge whether he's motivated? How long will he stay? What is his intention? So I go and listen to him. I mean, I listen to his interviews when he talks. I find podcasts where where he speaks. And you need. I'm not saying somebody will be able to be very subjectively judge things rightly in the beginning, but when you have done it for a fair amount of time, you start seeing things which is not in the number. But for example, if you're listening to the conference call of the management, what is the tone of it? Suppose you're listening to the conference call of Netflix when Reed Hastings is saying that we are going to stop password sharing and this. Why he's saying that? Why he didn't say this 3 years back? And those are the kind of questions which is very subjective. And I would say that, of course, subjective elements are involved. Of course, you want to go and understand management. Like when we were judging Aisha, we went to the factories. We wanted to know what the employees are thinking, but we cannot run to every factory. So track record is a good way, but you need to listen to the mind of the person. And and see, in investment, it is not a profession of certainty.
Mhm.
Any investment done with certainty can affect us. I mean, it can affect badly most of the time, because you are sure you are going to act stupid, and acting stupid can hurt. So I always tell these things which Warren Buffett wrote in a very good newsletter. So there's a newsletter from Columbia Business School called Grants and Dodd-Phil, Super Investor. So in 1984, if I'm not wrong on the year, Buffett wrote that there are three common traits of successful investor, and he's not talking about the Wall Street or Main Street fund manager or hedge fund manager who comes from CNBC. He is talking about the people who are doing this out of passion and they are trying to outthink others or think differently. The traits are, I mean, you are going to be wrong 30-40% of the time, because it is in the nature of capitalism, right? If I have to talk about the US business, I mean, the average life is 15 years. How
Mhm.
can you judge? How can you make? And I see Indian compounders. Somebody paused me and said that some fund manager said that this company is going to grow 15% for 100 years, and we are not even independent for 100 years now. If you're if somebody's logic is to assume that this business will be there after 100 years, we don't know. And that's why every business needs to be evaluated. And what investors can do the best is avoid the stupidity, avoid illogical rationing, and we will be wrong 30-40% of the time, because even the business is good, somebody will come and outcompete them, and we cannot model it, we cannot see it in numbers, we cannot see it. How somebody would have thought that Google will come and destroy Yahoo. And I was talking to Mansi because she was preparing her PhD paper, and we were discussing that how chewing gum business went out. And people think that some good chewing gum will come and destroy chewing gum business. No, smartphone came. People are not bored because they're looking into smartphone. They don't want to chew. And you cannot imagine this. Nobody can imagine this, right? So there is an element of uncertainty, and an investor has to be fine with it. So the first trait the Buffett says, which I completely agree, is, I mean, even with the best intention, best work, out of 10, 30-40% is not going to work. And you will still make good returns. You don't, if all works, I mean, you will be super rich. So 30%, 30-40% of your bets will not work. Buffett's own success rate is 60%. I think any less mortal will be like 50 to 60% will do good. But those five businesses which are not going to work should not be bankrupt cases. They may not grow that much, and you don't lose that much money, and then you make good returns on the businesses that work out quite well. So just objective analysis will not help. I don't think the numbers still solve the story, and there has to be a subjective element, and you need to think a lot. I mean, I always believe that investment is job of thinking. That's why I've even written on my website that my job is to think.
Mhm.
I read, but reading is what somebody is saying. Thinking is what I'm thinking, what they're saying, or somebody, because most of the things are conveyed differently. Like, I mean, suppose Indian government is going to bankrupt, they're not going to come on TV and say, "Hey, I'm going to go bankrupt and your money in the bank is good." They will say, "Don't worry, PMC bank will be fine. आपका पैसा कहीं नहीं जाएगा." लेकिन in reality, if you are judging, they need to say that पैसा मिलेगा. So I mean, there are a lot which is said between the lines, and we are always making judgment between that objective and subjective things. And it's a very good question. I mean, every investor is a good thinker, right? And it's in nature of future. How can you know future? I mean, future is so unknown. So so in that investment case, we build in that uncertainty, that some things we cannot figure out, and we need to be okay with it. And what kind of situation or valuation will make us okay with that, right?
Mm.
I hope I was able to answer your question.
Yes, Manish. I just want to add to that question. Like
Yeah,
you're
sure.
showing there are a couple of investments that were really good that you're projecting in your website.
Yeah,
But at the same time, there were failures, right? Like you're saying 40%. I mean, there is always a risk. I mean, yeah, those
yeah,
stocks, they have worked well.
yeah,
But at the same time, looking at this, should we not like have more, diversified portfolio in terms of there will be failures? Because that is like, I mean, instead of
yeah,
like you said, you're looking for good opportunities, but that could be wrong. I mean, if there are a couple of
yeah,
them, could be wrong. So do
yeah,
you give a benefit of doubt sometimes, like just taking it to diversify something because you don't find like a proper investment, or you don't do at all? Like let's say you found five of them and
yeah,
just trusting that five of them, 40%, let's consider it 50%. So two out of that, two or three will do well, and
yeah,
maybe two of them will not work out. So
yeah.
is this like pool of five is a diversified portfolio, or you go for some more here when it comes to a specific portfolio?
I mean, Ronit, you are asking good question after good question. That's again a good question. So good. I feel I'm talking about my family. So I feel my family will be well off if they diversify in a productive countries or productive currencies across. And that's a diversification. That's a diversification at the start. And then I feel if I buy businesses which are different, and if I buy businesses which are better and we have proven to be good, that's also a diversification. But how much? Do we invest in five? Do we invest in 10 or 30? More than 10 or 15, let's say 15, I think somebody is making fool of themselves. Nobody can understand 15 business. So you need to figure out, if I have to take out five business out of this 20, 20 is too much for me. I do it myself. I have, at the moment, I have 15 companies which I'm not invested in, but I want to invest. I always ask this question: if I have to remove five, compromise, what will it? And then I somehow remove two, still 13. Then I ask, 13 is still too much. And I'm telling you, these 13 companies have already done research. So I slowly narrowed down to 10. If I have to
Mhm.
invest my money, I will invest in 5, 6. But because I have to also invest partners' money, I invest in 10, 12. Because I know I'm okay with what volatility, but somebody who sees the values go down and up, they may have heartburn and stomach ache. So to take care of that, I invest maximum allocation to one business is 10 to 15%. So, and a total amount of investment is 10 to 12 companies. But like when I do in my brother's account, it's three companies. Because of course there is an element of risk, but there's also an element of reward. I mean, you want to invest in your best idea, not your 30th best idea or 20th best idea or 15th best idea. That's the idea. So there's no good answer. I mean, I have heard even Buffett talk about diversity. There's no good answer. I mean, it's more depend upon the individual, how they see it. Somebody may be comfortable like me with five or three. I feel my partner should be comfortable with 10 and 12. Somebody may be comfortable with 100. I know many mutual funds will invest in 50 companies. What nonsense. There's no 50 good companies in India.
you for a couple of few seconds.
Am I audible now?
Yes, you are audible.
So I said we had a good session. We had good questions and different questions. We touch upon things, and hopefully to meet again in 3 months. The idea is to talk so that even when some good questions are asked, we are also compelled to think, and it helps us, right? And we expect that. I mean, if I hope that time is worthwhile, and I was able to add some value, and if that is so, I think our job is well done, right? So once you can close the meet, have final words. And thanks everybody. Thanks for coming in. Enjoy the weekend. Enjoy life. Be happy.
Okay, sure. So coming to a close, if you liked our process and our way of investment, kindly spread the word around. Mention us to your family, friends, and colleagues who may find it helpful. And to connect further, feel free to write to us. We are also online at mindofmanish.com. And coming to a close, we would like to thank our partners for trusting us with their capital and for being a good companion of our journey. We look forward to serving you with the best of our ability. We would also like to thank our friends who took the time out of the weekend and joined us over the talk today. We believe we added value to your time, and we wish you well and look forward to see you again in the next quarterly meet. Have a good day.
Thank you.